Hello, CAPE students. It's time for some economics. I am Shanique Francis, and I'll be your teacher for this lesson. Let's get into it. Now, our objectives for today include to understand the circular flow of income, to understand the concept of national income, to understand the different ways of deriving national income accounts, as well as to interpret national income statistics, appreciate national income accounts in analyzing the performance of an economy, to show real GDP and nominal GDP, and also to appreciate the limitations of GDP. Now, I know that some of you are doing economics for the first time. Maybe you didn't do CSEC economics or you did not do Unit 1. And so I'm just going to give you an overview of what macroeconomics is for Unit 2 students. And for students who are also doing CSEC, this will be a part of your syllabus. What you learn in macro, it will be a part of your syllabus also. So, first off, what's the difference between microeconomics and macroeconomics? Now, the difference is that microeconomics focuses on the behavior of individual decision makers and agents or households, firms, while macroeconomics looks more at the wider scale of things, of how countries make decisions about production, distribution, and consumption. So they are related because things that happen on the micro level collectively will affect the general economy. Now, the main macroeconomic objectives that you must remember, and you'll hear throughout the lesson, and you'll see it also when you're doing your syllabus, what the focus is on. So the macroeconomic objectives looks at balance of payments, or BOP, which refers to a country's transactions with the rest of the world. So it includes imports of goods and services, among other things. Another macroeconomic objective is inflation. And inflation is a term that we hear often, and sometimes we use it and maybe we don't really know what it means. So inflation looks at the consistent increase in general price levels in an economy. So it's not just the increase in the price of one good, but it's more on a wider scale. Then another objective is unemployment. And unemployment looks at those individuals within an economy who are actively seeking employment. They want to work, but they're unable to find jobs. So it's not the persons who are at home and, decide that, they want to stay there, they don't want to work. And then the final macroeconomic objective is growth. Now, economic growth looks at the movement of a country in terms of its production or productive capacity. So when a country compares two periods, for instance, 2019 and 2020, if we notice that we're producing more goods in 2020 than in 2019, we will say that we have achieved economic growth, or there has been some growth. Now, one thing that is common in this subject area is models. So similar to how architects would have a miniaturization of a building that they are constructing or they plan to design, economics also has models. It's not necessarily something physical, it's more theoretical. And economic models uses diagrams and equations, and it also integrates assumptions. Now, the purpose of models now is to make an assumption about what's going to happen in an economy. Models are a simplification of the real economy. Note that things might not always work exactly as assumed or predicted, but models help us to simplify the economy for a better understanding so that policies and decisions can be taken. And economic models are also comparable to roadmaps. So we know when we look at the map for a road, a country, wherever the area is, it's smaller in the scale. And so if you look at two distances that don't look very distant on a map, that's not how it is in reality. So just to re-emphasize the point that the models in economics are really just simplifications. Now, one model that we will look at that's fundamental to macroeconomics is the circular flow model. Now, you might have already been introduced to this in your classes, so for some persons, this might be a recap. Now, a circular flow essentially demonstrates how money moves around in an economy. And some movement of money is considered to be income, depending on the agent and or the transaction. And some movement of money is referred to as payments. And we'll see how money is both income and payments. Now, I mentioned economic agents before. Now, who are economic agents? Now, these are actors or decision makers in the economy, and they are very integral to understanding the circular flow. Different agents have different roles. So, there are variations of the circular flow model. Depending on the source that you use as a reference, your textbook or your online sources, you might see different circular flow models. So typically, a two-sector model is very common, and that one might be, or is usually referred to as a closed economy. And I'll explain that a little later. There's also a four-sector model, and some instances there are five-sector models. Now, the four-sector and five-sector models are just an expansion of the two-sector model, and it includes other economic agents. So, the two-sector model considers households and firms as the main decision makers in the economy. Households are also referred to as consumers, and firms are also referred to as producer. I mentioned earlier an open economy and a closed economy. And when we're talking about an open economy, we're talking about a country that engages in imports and exports, meaning that there's interaction in the international market. On the other hand, a closed economy is a country that does not engage in trade. So we're going to look at the diagram for the circular flow model. Now, you'll notice on this diagram that you are seeing two markets. There is the factor market, which represents the market for the factors of production, and then there is the goods market. I want you to pay attention to the direction of the arrows, the outer arrows and the inner arrows. So notice that the two markets I mentioned before, the factor market and the market for goods and services, and also we notice the economic agents I mentioned earlier, which are households, which I also refer to as consumers, and firms who are also producers. So notice on your circular flow diagram that firms, they supply goods and services to households. We're looking at the outer flow of goods with the arrows that are a bit broader. So firms supplies goods and services, and they supply to households. Households supply factors of production. Now, to get this started off, how do firms produce? So first of all, the firms, in order to produce, they need the factors of production, which are land, labor, capital, and entrepreneurship. So all of those factors are associated with a household. Now, households provide those factors of production to firms, and factors of production have rewards. So the reward for land is rent. The reward for entrepreneurship is profit. The reward for labor is wages, and the reward for capital is interest. So households supply the factors of production to the factor market so that firms can have production, right? So firms need a physical space, they need land, and land is not always physical, but just in this example, they also need workers to produce the goods and services that they want to make. They need capital, machinery to produce. So when we're talking about capital in economics, it might not be the same concept of capital that you learned in accounting. So typically when you hear capital, we are referring to goods that are used to produce other goods. So it's usually machines. Okay, so after firms are provided with this, with these factors from households, in return, they use the factors to produce goods and services. But what do firms do with the goods and services that they produce using the factors that they've obtained from households? Firms supply the goods and services to the same households who provided them with the factors of production in the first place. So we notice what's happening. Firms are receiving, or they are demanding, factors of production from households, and they are supplying goods and services to households. We also know that there is a situation with households where they are demanding goods and services from firms, and they are also supplying factors of production. So they are both supplying and demanding. Now, the inner flow represents the movement of payments or income. So we note that for the factor market, households, we see an arrow moving from the firms to households. That's the blue arrow or the broken lines. That represents the fact that firms are paying households for those factors of production that they have received. And we notice that the green arrows, or the arrows that are broken, that are moving from households to firm, represents the payments made by households to firms for the goods and services that they are supplied with. So, my question to you is, can money leave the circular flow of income? And give a reason for your answer. I want you to think about it and hold on. So yes, money can leave the circular flow of income, but in this example, we did not look at that. We looked at a situation where the economy was closed and there were no economic agents that would warrant any withdrawals or leakages from the circular flow. So the way that money can leave the circular flow is in the form of withdrawals, right? And withdrawals looks at any income that is not spent on domestically produced goods. So what if households earn income but they don't spend it back locally, purchasing the goods and services that the local firms are producing? That would be considered a withdrawal. And we'll notice that withdrawals, especially in the form of imports, are present when we have an open economy. Now, this diagram is depicting the concept of withdrawals and injection. So I'd ask the question, can money leave the circular flow of income? And the answer is yes. But money can also enter the circular flow of income through investments. So investments can be done towards firms and production, and then households will also choose not just to import goods as a form of withdrawal, but if households are earning income that they're not spending on domestically produced goods, maybe they are not importing, but rather they're saving the money in financial institutions, that is also considered to be a withdrawal from the circular flow. So another question for you, if households spend all their incomes on buying domestically produced goods and services, and if firms pay out all the income they receive as factor payments to households, and if the velocity of circulation does not change, what will happen? Think about it. So if this happens, money will just continue going around and around from households to firm, basically in a circle, hence the term circular flow of income. Now, we want to look at the expanded circular flow model, which I mentioned earlier, that sometimes there are 4 and 5 sector models. Now, in my expanded circular flow model, what we're going to look at is the role of the foreign sector or international market, and also the role of the government. How do these sectors contribute to additional withdrawals and injections within the economy? Now, I mentioned the additional agents, and so we're going to look at it. But I'm going to describe what's happening in this image just in case it's not so clear for you. So we have governments interacting with both firms and households. And we also have the interaction of the international market with both firms and households. We know that there is investment, and then there's savings, there are imports, there are exports, there is taxes. We also should have transfer payments and subsidies. And I'm going to explain how all of this affects the circular flow. All right, so one question, what's the difference between the circular flow, the 2-sector model, and the 4-sector model that I just showed you? Think about it. So you have your answer. So the 4-sector model here represents an open economy because it takes into consideration the international market. And as you would have seen or heard, I mentioned that there are imports and exports in this market. So that is the main difference between the 2-sector model I showed you earlier and the 4-sector model that you saw. So let's go back to what the circular flow model takes into consideration. So because we have now included the government and the foreign sector, there are other things that are taken into consideration. So first of all, there will be payments by households for the importation of goods. So households will import goods from the foreign sector because now we're engaged in trade. There will also be payment by foreign sector to firms, and that's in the form of exports. So because we're engaged in trade, we're importing goods from abroad, but we're also selling goods abroad, right? So we're receiving payments for exports and we're making payments for imports. In addition, we also have taxes, and taxes are paid by who in an economy, right? We know that firms pay taxes and households also pay taxes. So both agents will be paying taxes to the government. Now, in return, the government also provides assistance to both households and firms. So government will pay subsidies to firms so that it will aid their production. Maybe this will reduce the cost of production for firms so that they can produce more of the needed resources for an economy. And in addition, government will also make payments to households in the form of transfer payments, you'll hear that term again, or welfare payments. So that was a lot. Let us look back at the injections and withdrawals. So try to find a way that makes it easy for you to remember what are injections and what are withdrawals. We know that injections add to the circular flow and withdrawals removes from the circular flow. And injections include investments, government expenditure, exports. And withdrawals are taxes, savings, and import expenditure. Note how each term is identified. So the symbol for injections is J and withdrawals is W. For investments, it's I, government spending is G, exports is X, taxes is T, savings is S, and M is for imports. You'll see these terms and you'll see the letters associated with each term throughout the syllabus. Now, we want to look at this concept of national income. And sometimes we hear it on the news, we hear it on the radio, TV, wherever, and we read about it. And what I find interesting about macroeconomics is that it helps you to understand what's going on in your country and in your world. And especially in a time like this, it's good to be familiar with these terms. Now, national income looks at the total value of a country's output, and it is usually assessed on a yearly basis. Now, national income accounting looks at the principles and methods used to measure the income and production of a country. And what is the importance of looking at national income? Why is it relevant? Now, I want you to consider something, and these are the things I want you to consider. When you're looking at an individual, when you're looking at the economic well-being of an individual, do you look at the income that they earn and what does it tell you about the individual? And it's same for a country, right? When you look at the country, do you look at the income that's earned by the country to make an assessment or judgment about the country's economic well-being? You know, by using the income to make those judgments, whether for individuals or an economy, do you think there are any flaws in making your judgments on this basis? So really what I'm asking you, when you look at the income that an individual earns or that a country earns, is it a signal to you that, okay, this individual is doing well because they earn a lot of money? Or if they don't earn so much, you say, okay, they're not earning a lot of money, so, you know, I don't think this individual is doing well. And you can make that relation to the economy. Do you make that judgment about an economy when you look at their income? So, what the income tells you about the individual, and it's a similar concept for the economy, is how much they can afford. So if you know that a person earns a certain amount of money and you have an idea of what the basic necessities cost, it is an indication to you that this person can afford to meet their basic needs. And it is also something that economists use when they're looking at a country to make a judgment about the country's well-being. Now, what we look at for a country, when one of the statistics that we look at when we're looking at economic well-being is GDP, or gross domestic product. Now, what is GDP? Now, my students who have done principles of business already, you would have been familiar with this term before. So the gross domestic product, or GDP, looks at the market value of all final goods and services produced in an economy within a given period. And I'm going to break it down for you. Now, when we talk about market value as it relates to GDP, we are talking about the price of the goods, the price of the good when it is on the market. So what is the price of the goods or services? That is its market value. When we say all of all, there is a slight exception. It looks at things that, one, as I mentioned before, we said the market value, but the goods has to go to the market and it has to be legal. So when we're talking about GDP, we're not talking about the value of things that are illegally produced or sold in a country. Those are not included in GDP. And we also look at the term final goods and services, meaning we're not looking at intermediate goods, we're looking at final goods. And you'll hear the term intermediate or intermediary goods as you go along. So an example of this, if we want to have an idea of how a country is doing in terms of production, and you have a construction company that is making blocks, but the blocks that the construction company is making, they're going to sell to another company who makes homes. Now, if you should look at the value of the blocks and add it to GDP, and then when the homes are finished, built, you look at the market value of those homes and you add it to GDP, there's going to be some double counting because you would have added the value of the intermediate good and the final good, and the final good would have already taken into consideration the value of the intermediate good, which is why in the definition it says it looks at final goods, or in some definitions you'll see finished goods. It also makes reference to the fact that the goods are produced within a country. As the word domestic suggests, it's not to say that we entirely ignore what's produced outside of a country, but that is something we consider when we're looking at gross national product. So for domestic product, we only look at what is produced within the country, even if we're producing goods in the country and the goods that were produced, it's been produced by a foreign firm, it's still included in our GDP. And then in a given period of time, the time is usually a year. However, sometimes they might make reference to shorter periods like 6 months or quarterly. So I mentioned before some things that would be included in GDP. I want to add the fact that when you're looking at GDP, it's not just goods, it also includes services. And examples, or an example of a service is rental. So when persons rent apartments, houses, those are included in the calculation of GDP. So whatever the tenants pay, that's included in the calculation of GDP for services. And just another quick point to note, there are some persons who live in their own homes and so they're not paying rent. However, provision is made for that. There's an estimation of the rental value of that property and it is added to GDP also. So we know, I just pointed out 2 additional things that are included in GDP, and I want to make mention of things that it also excludes. So we know what it includes. Let's look at some exclusions. So GDP excludes things that are illegally produced or sold in a country, the black market. That's not included in the GDP. And in addition, items that are done at home, so items or services that never reach the market, are not included in GDP. So for instance, in this pandemic, you decided to start your own garden or farm at home and you are producing food that you're eating. You decide to eat what you grow with your family. It's not included in the GDP because it never actually went to the market. It was never actually sold. You produced it, it's valuable to you, it helps you to save money and you consume it, but it's not included in GDP. And another thing that GDP, another example of something that GDP excludes. Now, say for instance, you receive some benefits from the government, right? Some sort of welfare payments. Because it's a payment to you or to individuals that does not contribute to any production in the economy, it is also not included in GDP. So welfare payments are not considered a part of government expenditure when we're looking at the calculation of GDP. And GDP measures two things simultaneously. It measures income and expenditure. So the income that people earn, that's the same income that they spend to consume goods and services, and that's why GDP measures those two things simultaneously. All right, so next we're going to look at the components of GDP. Now, there are different ways for measuring GDP. You will look at the expenditure approach, the income approach, and the output. Now, the components of GDP based on the expenditure approach is Y equals, and this is the equation, Y is equal to C plus I plus G plus NX. I'm going to break these down for you. Now, the Y here is GDP, and C refers to consumption expenditure. The I refers to investments, and you'll find that economic investment and accounting investments are slightly different. And the G is government spending, which, of course, as I mentioned before, does not include welfare payments. And NX refers to net exports. So we know the symbol for imports is M, and the symbol for exports is X. And NX is net exports. Now, consumption is spending by households, and this looks at spending that's either on durable or non-durable goods, consumer goods. Investment typically looks at purchases of goods that will be used in the future to produce more goods. So it's wealth used to create further wealth, such as machines, computers, inventory structures, such as housing. And government expenditure, I mentioned before, does not include welfare payments, but it would include things like salaries for government employees. Then there is net exports, which consists of, making adjustments for exports and imports. So to find net exports, you would subtract imports from exports. So what you're really doing is you're removing the amount of money that you spend on imports from what you earn from exports. So the country earns $5 from exports, for example, and they earn they earn $5 from exports and they spend $2 on imports, which means that net exports is $3. So it's a $5 earned from exports minus the $2 spent on imports. Now, when your exports are greater than your imports, your net export figure will be positive, which means you have a trade surplus. So when exports are greater than imports, it means that you're earning more on the goods that you're selling to other countries than what you are spending on goods that you're purchasing from other countries. And then there's also the reverse. Your imports could be greater than your exports, and that means that your net export figure would be negative, and this represents a trade deficit. So when your imports are greater than exports, you have a trade deficit. When your exports are greater than your imports, you have a trade surplus. Now, two very important concepts to take into consideration as it relates to GDP are nominal GDP and real GDP. Why are they important? So because we look at GDP as a statistic that indicates economic well-being, and we also look at GDP over different periods to have a sense of whether economies are growing or not, it is important to consider things such as price changes. So for instance, if Jamaica is producing and selling banana chips abroad, and we produce 5 banana chips in 2019 and we sell it for $10 each, we would have earned $50, right? 5 times 10 is 50 in exports by selling the banana chips. Now, if I tell you that in 2020, the GDP moved from $50 in 2019 and in 2020, it's $100. Maybe your first thought is that, okay, Jamaica is achieving economic growth. However, this might not be the case if it was only a situation where instead of producing more goods and services or producing more banana chips in this instance, we just increased the price from $10 to $20. So when we look at real and nominal GDP, we are taking into consideration what is happening with prices. So nominal GDP looks at prices that are not adjusted for inflation. So when we look at nominal GDP, we're looking at the price of the goods in the year that it was produced. But when we look at real GDP, we're making an adjustment for inflation, which means we're focusing on the quantities of the goods that are produced or services rather than just how much we're earning. So when we look at real GDP, it looks at constant prices because typically we're focusing on a base year. So in order to determine real GDP, we select a base year, and I'm going to give you an example of this. Now in this example, the years are 2017, 18, and 19. Now Jamaica is producing pencils, and we are also producing markers. We're selling pencils in 2017 for $10, and we're selling markers in 2017 for $12. How would you calculate our GDP in 2017? Now, the quantities for each of the products we're producing is also there. So to determine the GDP for 2017, we have to multiply the price in 2017 times the quantity that we produce. And we do this for both pencils and markers. And we'll notice that the GDP in 2017 is $3,600. If we follow the same approach for the other years, we'll notice that the GDP goes to $6,900 and then $7,470. But we have not taken into consideration that we noticed that the price of both markers and pencils had increased. So this is just the nominal GDP because it has not been adjusted. We didn't use our base year. We just used the prices for each year that the goods were produced. Now, if we're looking at real GDP and we select 2017 for the base year, what this simply means is that we are going to calculate the income that the country earned in the other years, 2018 and 19. We're going to look at the quantities that are produced in those years, but we're going to use the price of the base year, which is 2017. So when we look at the quantities of markers and pencils produced in 2018 and 2019, we're going to use the original prices. So we're going to look at the $10 for pencils in 2017 rather than looking at the $12 in 2018 and the $14 in 2019. And when we look at the price of markers, we're going to look at the $12 when we look at the quantity, $12 meaning the base year price, rather than the $15 in 2018 and the $18 in 2019. We'll notice that the real GDP is different from the nominal GDP. So if we go back to 2018, nominal GDP was $6,900, and in 2019 it's $7,470. But when we look at real GDP in 2018 and 19, we'll notice that the figures are $5,600 and $5,100 respectively. So this tells you that the nominal GDP almost gives you a false sense of growth because it doesn't take into consideration that you are actually not producing more, you just increase your prices. And the idea of growth is that you're looking at a situation where a country is actually producing more. Now, there is a very important concept, which is the GDP deflator. Now, this is used to calculate the rate of price change or inflation. And there's a simple formula for you to look at the GDP deflator. And this is done by dividing nominal GDP by real GDP and then multiplying by 100. This is how you find the GDP deflator. So it is important to note that the GDP deflator is always 100 in the base year. So if we look back at the examples we did earlier, we'll notice that the nominal GDP and the real GDP for 2017 would have been 3,600. So if the nominal GDP and real GDP are the same and you divide 3,600 by 3,600 and you will get 1 and you multiply it by 100, then the deflator in the base year is 100. For the other years, you'll notice different figures, and as such, when you subtract the 100 from the deflator, you'll get the percentage change in price. Now, this is what I was referring to. So in 2018, the percentage price change would have been 23.1%. So we've covered quite a bit today, and I want us to just keep in mind that we have some more to do as it relates to national income accounting. So don't forget what you have learned today when you're looking at your next topic or the next lesson. So just a quick question for you, and I want you to write these questions down. Do you remember what GDP is? Can you differentiate between the two-sector model and the four-sector model of circular flow? Who are economic agents and what are their roles? Also, can you differentiate between nominal GDP and real GDP? What are some things that are included in the calculation of GDP? And what are some things that are excluded? And I want you to also to do some reading to find out, how those exclusions affect the perception of the economy. In addition, I want you to also remember the components of GDP and specifically the expenditure model that I showed you. So do you remember the equation? Y is equal to C plus I plus G plus net exports. What is consumption? What is included in investments? What is government spending? How do you get net exports? Now, thank you for joining us today. It was good to have you, and I hope that you would have learned so much and that it will be the foundation for you to continue. That's all that we have time for today.